Let me thank you for joining us on the 15th anniversary of ET Now. I remember most of your speeches and interactions here on our platform on various occasions, not only on the channel, but many programs which you've been part of. You've always guided us and contributed in the discourse here. So thanks very much. We really appreciate your association with ET Now.
Thank you very much, and heartiest congratulations to ET Now, all the employees, all the stakeholders, and the viewers for completing 15 years. It's a very good journey.
Professor Subramanian, growth is the magnet for capital. We have seen, at least here on ET Now, we keep interacting with some of the top CEOs, not only domestically but globally too, who show their intention to invest in India because of the policy environment. How do you see the capital requirements? And from the vantage point you are at, do you also come across a lot of top global CEOs and even heads of state who are keen to divert their big pools of capital to India for the really long term? I'm talking about not the FPI flows which are more short term in nature, but FDI flows which are decadal and which take calls on a 10, 20, 30, 40-year view.
So yes, two questions that you've asked, Ajay. First, the requirement of investment. I think, in my earlier response, I was already hinting to the fact that investment is one of the key drivers for growth. If we look at the investment to GDP ratio, it is now again about 32%. My sense is, and in the estimations that I've done, India should be looking at closer to 40% investment to GDP ratio in order to get 8% growth with the kind of productivity improvements that are happening, the reforms. And this investment could be both domestic investment and foreign investment. Foreign investment does help in technology transfer, and in enhancing the productivity in the economy, and therefore FDI in particular. When I speak about the enhancement in productivity through foreign investment, it's primarily FDI, not FPI as much. So it is important to keep the ease of doing business in such a way that more FDI keeps coming in. We have to continue focusing on reforms. The last 10 years have been a good period for structural reforms. I would emphasize that one of the key areas that India needs to work on is factor markets, what we economists call factors of production, markets for factors of production, be it land, labor, capital, power, logistics, economies of scale, and these are 6 factors of production that are very important. I think our viewers have to understand, the policymakers also have to understand, while we reformed the product markets in 1991, we have not reformed the factor markets as much. There's been, good attempts, and there's been some progress in the last 10 years, but I think more work needs to be done on this front. This will really help in bringing FDI, especially in the manufacturing sector, which is something that we need significantly for job creation. Now, to your second part of the question, how global investors view India from the vantage point I occupy, and I get the opportunity to meet a lot of global investors because I end up going and speaking on many of these investor meets. The opportunity that investors now see in India is phenomenal because India can generate growth of 7% plus, and with some ambition and reforms, 8% growth as well. And in a global economy which is struggling to grow at even 2% per annum, 7% growth on average, actually, for an economy as large as India is, I think, something that provides significant opportunity for investors.
Right. How are you analyzing, the capital expenditure cycle which is undergoing right now in India, the way it has moved in the last few years, particularly our specific thrust on manufacturing? I want to also understand that where do you see it trending from here on?
So one of the things that I have come to understand, whether it's market participants or economists, we typically focus a lot on linear trends. But I think economies typically are not very subject to linear trends. So we have to keep in mind some non-linearities that would come in. That said, though, I think overall, if we look at the manufacturing sector, the Make in India is showing good signs. If you look at the factors of production that have been focused on, logistics costs have gone down because now road infrastructure is very good. Railways is also an aspect that is being focused on. Power sector reforms still need to be completed. A lot of the discoms in the states, in particular, are not very are not in good health, and that needs to be plugged. I think smart metering needs to happen so that pilferage of power and thereby the corporate sector paying a much higher cost for power is fixed. Also, land and labor reforms. I'm quite optimistic that in the next few months, the government will do the subordinate legislation, pass a subordinate legislation for labor reforms. I remember when I was with the government in 2020, the labor law bill, the four codes were passed. So subordinate legislation needs to be passed. That will help in reducing the cost of labor. And states need to work on bringing land banks together. So apart from that, the emphasis on economies of scale. This is something which is very important. I've written about it in the economic survey, the 2018-19 economic survey. A lot of our firms, they age, but they do not grow. And it is growing firms that create jobs. So we really need to examine laws and regulations that create perverse incentives for our firms to remain dwarfs. And remove those perverse incentives. For instance, if and this is a piece of evidence that I actually find it very compelling. If you look at a firm that is about 30-year-old in the United States, it creates about 7 times as many jobs, compared to when it was a 5-year-old firm. In India, that proportion is only 40%. In other words, firms aging create 5 times more jobs here in the United States. And that is something that India needs. And therefore, perverse regulations that create dwarfs in our economy, I think, need to be worked on as well. All these together, I think, can really make a big difference in furthering manufacturing. Because I'm clear there are a lot of commentators that mention that India has missed the manufacturing bus. That is not true. India has actually not worked enough on the factor markets. Manufacturing not growing as much is a complete policy failure, has been, especially till 2014. There's been good steps after that, but I think more work needs to be done, especially on the policy front to encourage manufacturing.
In fact, sir, if you could also share your thoughts on the broader economic model of growth which India is adopting. In fact, even coming out of COVID, we actually, did a lot of capex and focused. The thrust was on not handing over money and triggering consumption for the short term, but to create more structural job creation, which could last even beyond COVID. We were criticized initially because of that, but now everybody looking at the durability of the growth which triggered then. What are your thoughts on the model of growth which we are adopting versus many other models?
So there are a few factors. I get into detail in this, in what should be the economic strategy for India in my forthcoming book, India at 100, envisioning tomorrow's economic powerhouse. In that, what I describe is that India needs to have a 4-pillar strategy. And some of these I've already written about in the economic surveys. The 4 pillars have to be, first pillar is actually macroeconomic focus on growth and growth alone, because that is what expands the pie for welfare spending. Second is, creating a large middle class by, generating inclusive growth, and therefore social inclusion, economic inclusion is a very important part of the economic strategy. Third is regarding wealth creation and wealth creators as a boon, not as a bane. And I think some of the rhetoric during the elections was very unfortunate, which actually talked about inheritance tax or actually, wealth tax and other things, which I think it defeats the purpose. India historically has always been, and I've written about this in the 2019-20 economic survey, has respected wealth creation. In our homes, we write, Shubh Labh. We basically don't go and write, Shubh Hani or Ashubh Labh, right? So that is part of actually, do good and thereby create, prosperity and create profit. So wealth creation as a third pillar, and finally, and this directly answers your question about the virtuous cycle. I think it is important, to understand that, in the 2018-19 economic survey, what we had done was we had analyzed every economy post the Second World War that grew at 5%, not just for a year or two, but for a decade, and then analyze what is it that generated this kind of consistent growth. It was investment that delivered such growth. Investment leads to higher growth, and that higher growth then, concomitant with job creation, also increases disposable income, which then, furthers consumption in the economy. That is what leads to sustain. When you have, and this example is quite illuminating. If you look at the period during the global financial crisis, we just tried to, incentivize consumption, and that led to us becoming part of the fragile five with three, whammies, which was, double-digit inflation, current account deficit that was close to 6%, and fiscal deficit which was much higher than peer economies, and that growth petered out because that was not the right model. The model has to be of a virtuous cycle. We have to be patient as we actually get, more investment and thereby more growth, which leads to disposable income in the hands of people. That increases consumption, and that is indeed happening, and will continue happening as we focus on the right trigger for the virtuous cycle.
So, in that case, sir, do you expect meaningful improvement in the per capita income as well in years to come from here on? Because this virtuous cycle, the fruits may be slightly back-ended, but they have a very long tail to it.
Absolutely. In fact, see, we can do some math here. If we take and I'm talking in real terms, if we, let's say, growth is 7%, I'm being a little conservative. But if we take, GDP growth to be 7%, and population growth will be about 1% on average, with some states growing more than others, but 1%. So, 7% minus 1% is 6%. So 6%, rate of growth in per capita income is something that we can expect. And using the rule of 72, you will basically then get, in about a decade, you'll have doubling of per capita income. So over the next 30 years, we can expect about 7 to 8 times multiplication, because, over a 30-year period, there are sort of 3 10-year periods. So 3 doublings, which is about 8 times. So 7 to 8 times, increase in per capita income. If we can grow consistently at 7%, our GDP, and our population growth remains at 1%. So that per capita GDP grows at 6% per annum.
So, I want to talk about a subject on an area where, perhaps it doesn't really get its, focus, and that is the digital side of our economy and the contribution it is actually making in the growth side. India's, improving digital prowess, not only on the educated elite side, but at the bottom of the pyramid too. The adoption of technology triggered by policy has been good. Startup culture, now smaller town, tier 3, tier 4 startups are actually witnessing massive inflow of capital. I want to know your thoughts on its contribution in economic growth over a longer period of time.
No, I think that's a very good question. From the vantage point that I have here at the IMF board, this is one area where, we can be really proud of, because the kind of leapfrogging that India has done on its public digital infrastructure, starting from the Jan Dhan Yojana, which I mentioned earlier, more than 500 million bank accounts, 95% of which are very active. I think that has really helped in taking the digital infrastructure to the grassroots. One can take several examples. When I visit India, even if I want to have a coconut water, one dab, actually, I can pay that thela guy just pulling out Paytm or Google Pay. Last time when I was actually in India, in Mohali, my mother stays there. I went for some grocery shopping, and I pulled out my phone to pay 57 rupees for some onions that my mother bought. This is in a mandi, and so that is actually illustrative of the kind of inclusion that has happened. Or more examples, if you go to a fashion street in Bombay or a Sarojini Nagar in Delhi, 10 years back, you would have had to pay cash to those hawkers who actually don't have a shop, who sell on the streets. But today, you can actually pull out your Paytm, pull out your phone and pay using Paytm or Google Pay. And these folks can then go and take credit. They can actually go and show that data to the banks. And this is an area where I think we need to really our regulators need to think about expanding credit significantly, especially cash flows based lending, and enabling more fintech, because the kind of digital infrastructure that we've created, if we are too conservative, in credit creation, and not utilizing the wonderful infrastructure that has been created, that would be an opportunity loss. So I think this is something that is really important for us to do, and it is important, to recognize that this digital infrastructure can actually lead to inclusive growth, because unlike in the other economies, this digital infrastructure has been created by the sovereign, and therefore access is almost universal. And therefore, whether it is for transfers or welfare spending, it can be really well directed, and thereby enable inclusive growth and a furthering of a large middle class, which I spoke about as a second pillar in the 4-pillar strategy for India to become a very large economy and a rich economy.
Right. No, the cash flow based credit and the way it is actually funding a lot of SMEs for that, for their growth, is an amazing point you've raised, because we speak with a lot of fintechs on the channel and they are again and again talking about 30-40% growth, where average lenders are growing low, and that too with barely a percent a quarter kind of NPAs, because the digital infrastructure is ensuring that. But I want to, please allow me to be slightly short term or near term views as well. I cannot let you go before understanding your thoughts on the rates environment, not only globally, but our policy focus has been very different. We are not one-to-one aligned with the globe as far as rates outlook is concerned. But your thoughts on global interest rates, and are also where interest rates could be heading, because that does impact cost of capital here in India too.
I'll definitely respond to that, but let me add some more color to the fintech lending aspect that you spoke about. As economists, we all think about two problems in credit risk, which is adverse selection and moral hazard. Adverse selection is you want to reduce the problem of lending to bad borrowers, and moral hazard is being able to monitor borrowers. Eventually, when it comes to credit risk, it is about these two problems. And when we look at collateral-based lending, which India has actually had, almost 95 to 96% of our lending is still collateral based. Why is collateral used? Collateral is used to reduce both these problems of adverse selection and moral hazard. So now when we have the digital infrastructure, to be able to take care of both the adverse selection and the moral hazard problems, we do not need to actually rely only on saying, you have to do collateral based lending. Unsecured lending is too risky, and therefore, you cannot grow at very fast rates. I think that is something which will actually lead to this opportunity, through the digital infrastructure that we've created, not fructifying. And that is something which will be very unfortunate. So it is really important for our policy makers to recognize the opportunity and make sure that, the public digital infrastructure is utilized very well for fintech growth. Now, when it comes to monetary policy, I think you said it very correctly that India was, the outlier, had followed sui generis policy, during COVID, both on the health front and on the economic front, especially on the economic front, being very careful with its, with its spending and implementing both supply and demand side policies. And that is why India did not face as much of an inflation problem. Do remember that, all the global economies, and especially the G7 ones, had anywhere between 2.5 to 4 times the historical average inflation, while India's historical average inflation being about 7%. During COVID, it has been less than the historical average. So, which is something which is testimony to the kind of economic policy that India implemented. Given that, therefore, I actually think that the time for us to get into a monetary easing is, I think, is optimal now, because inflation is also quite moderate. Here, I have to mention 2 key points when it comes to monetary policy. First, if we look at the nature of demand, and people typically talk about only demand without distinguishing between investment demand and consumption demand. I like making a distinction between the two, because when you look at India, people do not borrow to actually eat food or maybe go on a vacation. People borrow only for maybe buying a 2-wheeler or 4-wheeler or a house. In other words, durable goods. So a large part of consumption, therefore, is actually not as interest rate sensitive. In other words, consumption demand cannot come down very very hugely when interest rates go up during a monetary tightening cycle. But investment, almost one for one, investment gets impacted by by interest rate hikes during a monetary tightening, and therefore there is this asymmetric effect, where monetary tightening in a country like India, not in the advanced economies, but in a country like India, increases, or the impact on investment is far greater than on consumption, and therefore it is important for monetary policy to make a distinction between investment demand and consumption demand. A second factor that is also important is that if you look at our banking sector, when, for instance, there is a monetary easing, it is not as if a borrower who's basically, let's say, banking with Bank A, goes and tells, Bank A that, look, Bank B is willing to actually give me a lower rate loan, and therefore you reduce my interest rates. And therefore, if you look at monetary policy transmission, during a monetary tightening, banks pass on the rate hikes almost one for one. But during a monetary easing cycle, they do not pass on the interest rates decreases as immediately, and therefore this is the other asymmetry that monetary policy has to be very cognizant about as well. And therefore be careful about, because as we were speaking earlier, it is actually investment that drives the virtuous cycle and leads to consistent and high growth. And this is an aspect that monetary policy must be cognizant about.
Right. Professor Subramanian, can you talk to us a little bit about a case building for a rating upgrade in India because of the policy continuity, because of prudent measures the RBI and our policy makers have actually taken, because of superior growth? Is there a big case for rating upgrade for our sovereign rating?
You're basically asking the choir to sing here. You would remember that in the 2020-21 economic survey, we had written a chapter which was titled, "Does India's sovereign credit rating reflect its fundamentals? No," with an exclamation mark. And there we showed a plethora of evidence that the Indian economy's sovereign credit rating is not justified by its fundamentals. I'll just give you one simple statistic. The fifth largest economy in the world, since the time sovereign credit ratings have actually been implemented from the 1960s, the fifth largest economy has never ever been rated triple B. The fifth largest economy has either been a triple A or has been a double A, and that was when China became the fifth largest economy. And why is the size of the economy important? Because when you look at the credit rating, as a financial economist, it is nothing but a mapping onto the probability of default. And the probability of default itself is a function of just two things, which is the ability to repay and the willingness to repay. The ability to repay is not a function of GDP per capita, which is what the sovereign credit rating models use, but it is a function of the GDP, overall GDP. And that is why the fifth largest economy actually being rated triple B is, I think, something which actually, if I were to use harsh words, I would say it's a joke. When it comes to the willingness to repay, India, even in 1991, when we faced our worst balance of payments crisis, we actually shipped gold. And incidentally, we brought back some of that gold now as well. So we've actually been absolutely gold standard in terms of the willingness to repay, when many other economies, actually peer economies, have defaulted multiple times. So, as a financial economist, when I look at this with conceptual clarity, and I have no hesitation in saying that the sovereign rating models actually are a hodgepodge empirical model which rely primarily on per capita GDP, because that fit the data before the global financial crisis very well. But if sovereign credit rating, where actually companies were using conceptually correct models, India would actually be rated at least an A or maybe a double A.
Clearly a very strong case building. Sir, leave us with a bit of a teaser about your new book, India at 100, a $55 trillion economy by 2047, audacious or achievable. And also tell us, how did you go about writing it? How much time did you take and the process of it?
So thanks a lot for asking this. I'm quite optimistic about the Indian economy, as I'm sure you would have noticed all through even during the time when I was with the government. I remember when I joined in 2018, there were people who were talking about India hitting the middle income trap, when growth was declining. And I remember mentioning at that point in time that the growth decline was only because of the problems in the financial sector. It was the overhang as a result of that. and that India will get back to 7% plus growth because there is nothing structurally wrong with the economy. And I look back with a lot of satisfaction that that assessment, indeed proved to be correct. That leads me to then project, so the thoughts about India's, future started germinating around that time. And, the economic surveys that I wrote, the virtuous cycle, the one on, the theme on the 2018-19 theme on, virtuous cycle, the economic strategy for a $5 trillion economy, wealth creation being as a boon in the 2019-20 economic survey, and the 2020-21 economic survey on post-COVID economy. All of those actually brought a lot of thoughts together. So the ideas, were germinating at that point in time. But ever since I actually relinquished office as CA, for about 8 months that I was there at the ISB, I spent a lot of time working on, on the book, and I've continued. So a lot of weekends and times after office have actually been spent. My wife can complain about this. That's what has led to the, to this book. So I'll leave it, leave you with the teaser. If India can grow at 8% per annum, then India can be a $55 trillion economy.
Outstanding, sir. Thank you so much for your time, and we are really looking forward to, get our hands on your latest book. Thank you so much for accommodating our request, and great to have you on the show.
My pleasure.